Welcome, everyone, to the next installment of the Trade Finance Global Spotlight On webinar series. This is Spotlight On Digital Asset Finance. My name is Charles Osborne, Director here at TFG. I'm delighted to be joined by Meriam Ayati, CEO of Neo Holdings and co-founder president at Water Commodities, Alexander Peters, CFO of Talk Commodities, Jean-Marc Bonifus, Managing Partner, Tellurian Capital Management, Dina Reitman, Partner at Fager Drinker, and finally, Tom James, Co-founder, CEO, and CIO at Tradeflow Capital Management. So, digital asset lending, crypto financing is something I only first started seeing a little bit about in the mainstream media at the beginning of this year. So it's not something I'm hugely knowledgeable about, I have to say. But one thing I do know a lot about is the trade finance gap. This is now documented to be well over 2.5 trillion and growing. And we've got other kind of quite damning statistics, such as 45% of SMEs applications getting rejected. So clearly, new liquidity needs to come into the market. And hopefully, this is something that can be quite innovative. So, this panel aims to not only shine a bit of a light on digital asset finance, but provide a bit of education to it as well. Perhaps we can start this panel with everyone doing a short introduction. Tom, if we come back to you, perhaps you can start us off.
Sure, no, it's great to be here. So, yes, Tom James from Tradeflow Capital, it's a group that me and some co-founders set up. The idea back in 2016, we launched in 2018 a series of funds to help address the trade finance gap. My background, 35 years in commodity trading and risk management through both mining firms, energy trading firms, banks, government agencies, and in terms of digital assets, we've always looked at how to use both blockchain, the technology itself, initially since 2018. So we've always tried to digitize all the processes in our business for scalability anyway. And so naturally, we're also quite curious when we looked at digital assets, stable coins, etc., and how that could be used to speed up efficiency in terms of the movement of money, collection of money as well in transactions that we've invested in. So it's great to be here. Look forward to the conversation.
Hello, everyone. My name is Dina Reitman. I'm a partner at Fager Drinker, and I've been in energy commodities and derivatives since I've been 18 years old, starting my career on a energy commodities trading desk as their office manager, actually, while I was going to college in New York City. So I have been, for the past, I won't say how long it is, but way over 20 years, been in commodities and energy. And it's just been a lovely background and experience to have that has led me to this great job that I have to help clients figure out ways to use digital assets, figure out ways to digitize commodities, figure out ways to create marketplaces and platforms and assets that they can trade, use as an underlier for a derivative, perhaps set up exchanges. And all this stuff is very exciting for me because we're beginning to see, as you were going to talk about today on this panel, everybody, finance and how digital assets are becoming a very important part of the story when we're talking about finance. And it's just going to be a big boom, and I'm excited to be a part of it, and I'm excited to be on the panel. So thank you for having me.
Good afternoon, everyone. My name is Alexander Peters. I'm editorial board member of TAG Format and CFO of Torque and Origin Commodities. I'm here, to voice the physical commodity traders. I have spent, close to three decades in the industry, and what I have observed, in the last decade or so is the widening of the trade finance that Charles has just announced in his induction, from 1.5 trillion to 2.5 trillion growing. What's my link to cryptos? I'm resident, to Zug, which has its nickname Crypto Valley. So I'm literally at the epicenter of the action here. So please do participate in this format.
Hello, everybody. I'm Jean-Marc Bonnefou, the managing partner of Taylor and Capital. Um, my initial career was started in commodities back in the days, 22 years ago, in the leading bank at the time in commodity trade finance team. And I moved to the trading side and became head of commodity derivatives in that global bank for quite 10 years. Created a hedge fund, commodity hedge fund, in 2007. And my kind of epiphany, discovery of crypto happened half a dozen years ago when we started trading systematic crypto assets with the hedge fund. And now where I'm sitting with the experience on commodities and crypto. I kind of identify, like the other colleagues on the panel, a number of crucial synergies where we can move a lot of the commodity finance workflows onto crypto rails and create a very positive network effect for the commodity industry.
Hi, everyone, and thanks, Charles, for having me. I'm Mariam Ayati. Like everyone else on this call, I grew up in commodities. My career was mostly Shell within the LNG and oil trading businesses. And most recently, I created and ran Shell's first global origination and investments practice from the trading business, looking after oil products, complex deals, and new things that might move the needle on how we do business. That took me to a world of blockchain and decentralized finance early in 2016, where with a bunch of friends from the other trading houses and super majors, we realized the emergent opportunity around these blockchain-based infrastructure at that time. I don't think that the financing angle was quite ready back then. So we launched, and I was elected to chair the first industry coalition that invested in these blockchain projects. Some of the ones we spun out are probably household names by now. Things like VACT, which does post-trade processing for Brent crude. We launched to 67% market participation on day one, which was nuts in 2017. Then Comgo, then Eliox, then many others. I left Shell after that to co-found Water Protocol and Neo Holdings because I could see this immense opportunity emerging where when that technology becomes mature, and I think there was a maturity question, right? And when the regulation becomes aligned with that technical maturity, and when the capital flows in, the opportunity to change the game in how we do commodity trading as a whole, pricing and financing would be immense. And I wanted to learn how to do it from inside on the other side. So we had the privilege of partnering with a lot of mining companies such as Rio Tinto and really setting the pace on track and trace and digital assets in the mining and minerals industry. And now we're kind of bringing it all together with ReserveNet, which really goes into tokenization and financing of the end-to-end with new pricing benchmarks.
Great, thank you. Thank you very much, everyone. It's clear that we have a lot of experience and expertise on the commodities market. Everyone just looks a lot younger, perhaps. But so I'd say that we're in very good company with this panel. And it's exciting to have so much expertise talking about something that's actually quite new. So Marianne, perhaps if we can stay with you here, actually, I think it might be a good opportunity to start this with perhaps a little bit of an introduction on crypto digital financing within the CTF market.
Happy to. And I get asked this question so many times that last week I actually put together a 20-page primer on explaining how these two worlds should think about each other. So if anyone wants it, happy to share that. But the way I think we should look at this is there are historical precedents when technology and regulation aligned to fundamentally change the way we look at the markets. So think about the 1970s and the digitalization of the stock market. Think about the 1990s and early 2000s and the creation of this whole financial market around oil trading, which gave birth to the Brent benchmark, to ICE as the platform that really did away with the call-out trading machines we used to have and trading houses, and the introduction of SUCO, the Shell UK 90s contract, which created the world's first open source contract for trading oil, and that led to financialization. I think of today as exactly that same inflection point where commodity infrastructure, commodity pricing, and capital meets an emerging set of tools that will change the way we do business. And so we'll talk about stablecoins, and I know many of the colleagues on the call are experts on that. So I will posit that stablecoins are a given, right? They just hit $314 billion in US denominated ones. These are regulated, and that's up from 200 billion at the beginning of 2025. So if you want to look at a hockey stick, the top two stablecoin issuers today are the world's second largest bank. That's huge, right? And then you have to think about regulatory arbitrage, and we'll talk about regulation, but actually the US has decided to be a leader in this space. And we're seeing regulation open this up in ways it never has before. Why does that matter? It matters because when you talk about commodities, the CFTC being involved, which governs derivatives and trading, as well as the SEC kind of being very clear about what it will regulate and what it won't regulate, fundamentally changes it. So a place like the US, which is traditionally less led on innovation, can do that. And Alexander, I love Zug. Our foundation is set up in Zug, but that's been a real challenge and a barrier for most people trying to do business outside of Europe. So the US coming into the market in earnest, following what Singapore's already done and what the Middle East has done, is incredible. That regulatory arbitrage is a huge opportunity that I'm sure Dina will talk about. And then we talk about, $3 trillion potentially in trade finance gap, but it's not just about that. It's the whole financing of the commodity life cycle that can be altered by injecting and expanding the available capital pool, which isn't going to come from the traditional banks because they've decided how far they will or won't go. But for this new alternative capital to enter the market, it really needs rails it understands, rules with which it can participate. And in my humble opinion, it needs the genuine participation of the giants of industry who control the flows. So without the flows of the giants, we'll tap into bits and pieces of the value chain, which is great. That's how innovation happens. But unless we integrate them, it's going to be challenging to scale. And every conversation I'm having, which I get really excited about, is that the giants not only understand this, they're experimenting, they're excited, and it's really about aligning them. So I'm incredibly excited. I'm also keen that we make sure we understand the risks. And so when any of our partners is approached by someone who is crypto native and is promising the world without understanding our constraints as an industry, without understanding the regulatory rigor, the compliance rigor, the fact that people start talking about tokenizing and financing flows, but what are you going to do if there's a liquidation event? What are you going to do if there's force majeure? All of that complexity of the real traded system needs people like us collectively and the bigger community of those building bridges to navigate it. I want to stop there, but there's a lot to get excited about.
No, thank you, Mariam, for the very comprehensive overview. That's exactly what we wanted to hear. You also mentioned stablecoin, and this is something, Tom, you and I have discussed quite a bit. So I'd love to get your take on stablecoin implementation within CTF as well.
Sure, absolutely. I mean, we're part Tradeflow Capital, we're part asset manager and part fintech. The fintech enables what we do in an efficient and cost-effective manner, digitizing the enablement of other people's trades around the world, import, export of commodities. That gives us the data and information and the speed. Stablecoin was not accessible to us until the end of 2023. That was the earliest point, mainly driven by regulation coming in. We understood the technology, we liked and wanted to use it for a long time, but regulators initially in Europe, in Switzerland, now also here in Singapore, where we're headquartered, have brought in the legislation to enable companies like us who work in a regulated environment to be able to touch and utilize stable coins. We borrow stablecoin, we borrow USDC and Tether. USDC was the first, as that actually became rated. So again, not sort of touches on regulation. We're starting to see the credit agencies, the credit rating agencies also stepping into the digital asset space, which helps the adoption, clarity around the safety of using certain types of digital assets, which has also been a great benefit to us and others, and the regulation allowing us to, regulated market, initially in Switzerland, borrow these stable coins from institutional, even hedge funds, and large organizations, household names that are holding these stable coins, wanting and looking and needing yield, ways to generate yield. And obviously, commodity industry, it's real world assets, real assets. Yes, it moves around on ships, moves around on trucks, but they are in demand, consumed commodities generally, and they're easily disposable of, and valued in terms of a mark-to-market valuation. So, a real-world yield play we're starting to see there. We've done hundreds of e-bonds in the market since December 23. We've been able to initially deploy most of that as fiat currency. But I'd say over the last year, we're now starting to see more and more of the suppliers and manufacturers of commodities that we buy commodities from on behalf of SME end buyers, who we're kind of funding their trades on. More and more suppliers accepting stable coins instead of a fiat currency, bank transfer, etc. So we're really starting to see the adoption. And I know, we want big trading companies and stuff to adopt and use this from a dollar scale perspective. But where we see it is very much grassroots adoption, where we work in 18 countries, over 35 different commodities, with hundreds and hundreds of SMEs all over the world and touching thousands. I mean, we're touching touch points of like 500,000 farmers already just on the east coast of Africa. These people already are familiar with mobile banking on their mobile phone. They don't go to a bank branch. So we're seeing in emerging markets in particular a real momentum to stable coins and digital asset payments, not just stable coins like USDC or Tether, but also even Bitcoin. In some countries, you can use it as a legal tender to buy your pizza and pay at your restaurants and do your shopping and stuff like that. So that adoption definitely is faster in some countries because they don't have maybe such a good banking system, or they don't have so many legacy systems. I compare it a lot to the situation where we saw emerging markets. They didn't bother to put copper cables in to connect telephones. They just went straight to the latest, mobile phone technology. And I think we're going to see a similar thing in terms of the use of stablecoin payment rails. Another encouraging thing, just to share quickly, is this is not in competition with SWIFT or bank networks, and we're seeing bank acceptance and acknowledgement here. First it was PayPal, now banks, because SWIFT, since October last year, I heard and read an article that they've been doing proof of concepts integrating stablecoin blockchain payment rails with SWIFT network. So, it's coming. The integration, the interoperability is already there, even if it's not switched on.
Thanks very much, Tom. So I guess, that's a very, very interesting overview of that as well. And I guess it's, the positive thing is that worldwide it's being adopted slowly. I guess it's slowly but surely kind of coming along. The commodities market is one that has been accused of being somewhat antiquated at various times. So it's interesting to see how they might potentially adopt this kind of technology as well. But it shows that worldwide it is gradually getting accepted. Just moving on to another point that I kind of started with, which was talking about the ever-growing trade finance gap. One of which that the ADB had put forward as essentially 2.5 trillion, now gone up, as Alex rightly said, from 1.5 trillion. So this is clearly growing. Is this a potentially a possible solution? Is crypto financing something that could come in and alleviate this somewhat? Alex, what are your thoughts with your kind of trading background? What is your thinking on this?
Well, thank you for the question, Charles. So definitely to address the growing, trade finance gap, we do need to look, into different new liquidity buckets. So, and specifically, when it comes to SMEs, small caps, mid caps, enterprises, I think we all can agree that blue chips, majors in the commodity industry are fairly well capitalized, have very good access to capital markets, to private investors, and similar pockets, of equity and debt financing. But when it comes to SMEs, I think, what I've seen over the last decade, that the benchmark have deteriorated. So, the minimum equity requirements have gone up. And that's not just, because of geopolitics, of crisis, of COVID, of everything, that's causing, headwinds in the industry. But it's also, that because of the regulatory aspect, a lot of banks, commercial banks and lenders have been retrenching over times. And then also, as we see, due to geopolitics today, we have also a de-globalization effect that, economies are not as interlinked as there used to be. So that really leads, to the need, of addressing that trade finance gap. I think, crypto economy has the right answers. What I've seen, years back, I have been working on a pilot with Swisscom blockchain AG. Swisscom is, as we all know, the leading telco in Switzerland, similar to the likes, of Vodafone in UK. So they were working on a blockchain platform, and I had the privilege to participate in that. They're actually where my journey started about securitization of commodities. So looking at commodity as an asset class. So this is something that really fascinates me, and I believe there is a lot of liquidity there. So just tokenization of commodity assets. And we're not speaking about commodity per se. It could be also asset classes, like if you look at a borrowing-based structure, an asset would be an underlying document like a warehouse receipt or holding certificate or a bill of lading or a corresponding receivable if you're looking into a trade cycle. And there are quite a lot of initiatives out there addressing that. And I think, that's a fascinating initiative. If we add, the vast liquidity that we see in the crypto economy, the 300 billion plus, a number that I have picked up today in our discussions, this is just something to start with. And we know for a fact that the likes of Tether are starting lending into the commodity space, on a stable coin, so a stable coin basis. So what I have seen literally in the physical commodity space, that the crypto economy started already replicating the financial markets that we know, from the real world. So starting, with trading platforms that tokenize commodity assets, starting like title documents, like warehouse receipts, bill of lading, and receivable that I mentioned. But equally, it comes, to fully functional FX transactions. I think it's no mystery that in certain Western African countries, and not just Western Africa, but across the world, you will have currency controls in and out, which also creates additional liquidity gaps. So there are platforms where really can do FX transactions and even whether it's OTC or fully regulated, where you really, crypto meets fiat and the way back, where you really can do FX hedging based on crypto meets fiat. So that's also a fascinating world, again, replicating the financial markets, the banking industry as we know. And it goes a full range, from to the likes of balance sheet financing, where based on the strength of your balance sheet, you can raise a crypto bond or place a crypto bond in a financial market. So the only caveat here is still the vast liquidity, that the crypto universe brings with it is still not really replicated one-to-one into this market. And there is still a lot of potential for improvement that really the vast liquidity that the crypto universe offers flows into this platform. Because at the end, placing a bond, it's literally the same process, getting a score on yourself, get a credit rating, look at the credit capacity, place a bond, and then looking for subscriptions. Of course, what I have seen so far, specifically crypto investors are more efficient, than real world investor. And I really have seen a subscription within crypto bonds subscribed within 2 hours, which is really a fascinating thing to see. I didn't want to believe it myself in the beginning, but then I witnessed it myself. And, it was really amazing to see that, how responsive crypto investors are. And it's also additional flexibility to the market because, again, it is an additional pocket of liquidity. The only restriction that I've seen, I mentioned it during, the FX case study, where I said like crypto meets fiat. It's a little bit still where the industry is struggling is commercial bank dealing with cryptos. So still a lot of issues on the regulatory side. Once I have dropped a question at a forum, at a discussion, I said like, if you had a borrowing-based structure where traditional lenders are syndicated in, and you would have one of the stablecoin provider wanting to join a borrowing base with a large ticket, would that work? So like simple answer was no, they wouldn't pass KYC. So this is still
Wait,
one of the
Alexander, I have to jump in here just to broaden the conversation beyond perhaps Zug, because we are also banked in Zug, and I would argue that there's a lot of regulatory restrictions that don't necessarily exist in the rest of the world, and that there's a lot of really large market participants who have solved some of these on-ramp, off-ramp questions. And most of those large market participants actually come from traditional markets. They're coming from traditional capital markets. It's the same financiers, for example, I would have called when I was at Shell Trading to get trade finance in Africa or trade finance anywhere else in the world. Those people aren't in play. And one of the largest players in crypto assets is JP Morgan, which is the world's largest bank. So I think I just want to be really clear here that the nicheness of some of these clunkiness is geographically specific. It's also when we start to talk about the value of this digital assets just as a way of augmenting capital to the underserved, we are creating fundamentally new barriers because the underserved, often it is an infrastructure question. Often it's also a credit worthiness question. Often it's a risk appetite question from the financiers. And one of the biggest sort of myths I hope we can bust here is that crypto money isn't just sitting there naively and kind of stupidly waiting for us to tokenize something that they put their money in. They're often incredibly savvy. And if we can't get a traditional bank interested in something we're offering it's not smart to think that the crypto investor would want to come in and back it. And so some of the underserved conversations also have to understand that the limits we're seeing are posed by the credit worthiness and the desirability of the assets that are being financed. And I also think it's really important to think about this in a much bigger lens than $300 billion of stablecoins. Tomorrow, through a whole series of stablecoin partners beyond the two big ones of Tether and Circle, any of us could issue stablecoins as long as you have the money in the bank, and they provide that as a service. And any of us can go and access the yield of 4%, 5% treasuries on issuing our own stable coins, as long as we had the regulatory permits in places like the US. And any of us could give that capital fundamentally different yield than the risk capital of going to the last mile, which is important, but it opens up $4 trillion, which is the digital asset market, into a asset investment that's way beyond what's available in stablecoins today. So I think it's really important to kind of think about that bigger opportunity as well, and not be too concerned about the barriers and blockers that are very much the same barriers and blockers the banks and the trading houses and the super majors have hit when trying to finance places, projects, or geographies that aren't financeable, right? So I think that's super important.
If I can jump in here, I mean, I totally agree. It's a holistic solution. So, I mean, obviously, stablecoin runs on blockchains of different types and sizes. Blockchain itself is a very secure technology, which has enabled certainly us to take small, medium-sized firms you wouldn't lend money to. They're in countries you might not like. They may not have enough track record for a bank to lend. That's why we don't lend money, but instead use an asset-backed approach, but which then adds the complications. You have to be able to use Internet of Things devices, plug into tracking, tracing, prove provenance, and know where things are and how it's been kept, which is now. So I think the interesting thing here is we're seeing a convergence of technologies. We're seeing the digitization and connectivity of the real world. Huge amounts of data on where things are and what they are. And stablecoin is just a more efficient way to move value around, which is also on the blockchain. So that's also useful. So the fact that we can create programmable money, and I think it leads into, one of the fundamental issues is, well, okay, we've now created SME unbankable transactions and turned them into A- investment grade. And in fact, recently we've even been able to get the insurance markets to back us such that we can offer 100% capital protection wrapper on deals that go through our process. So there's a digital process, but there is also a legal infrastructure that's been tested. And there's also the asset monitoring and management stuff, which is now available, certainly post-COVID, thanks to digitization by shipping firms, by port authorities, and by warehouse companies. So you can plug into all of this information, and because it builds trust. So this should hopefully reduce the cost for banks in the future to evaluate those transactions. Banks want to lend money, but the fundamental problem was it just cost too much money to do the KYC, the AML, the KYT, the know your trade, and everything else. Because if the trade is below, say, $20 million, well, unless you're doing a lot of them, it's just not profitable to have you on board as a bank customer. And so I think, I agree, stablecoin is going to grow massively because it's better, cheaper, faster. We're using stablecoin because it means it's faster, cheaper. We can move our capital faster across more transactions as an investor. For counterparties all over the world, it's quicker and cheaper for them to send money to us. And often they can also get a better foreign exchange rate as well than perhaps they would get at their local banks in their emerging markets. But most of the time, it's actually that their banks don't have the dollars. That's the problem. So they can't send the money to us. So I agree. It's a holistic thing that's going on here, and I think we're seeing a very, very exciting convergence of these blockchain technologies, which are actually solving real problems and enabling, cheaper, better money. And I think opening up more liquidity pools, mainly due to what Alex was talking about, tokenization of assets. The first time I ever got involved in tokenization and looked at what this blockchain tokenization can do of an asset was in 2016, and it was actually to do with LNG cargoes. So working with the Singapore government, we wanted Singapore to be a hub for LNG trading. The biggest problem is LNG cargoes are worth huge amounts of money. And how do you syndicate financing on a $300-400 million cargo effectively and open up more liquidity for financing? Now I've gone completely the other end of the spectrum of like $500,000 trades. How do you do that cost effectively and be able to invest in it? But tokenization means that certainly from the investor standpoint, you have massive diversification opportunities. Instead of having to put $20 million in a deal, you can put $1,000 in. And to Alex's point, we're one of the companies at Tradeflow who has benefited from e-bonds e-notes being issued in Switzerland. It takes us 15 minutes to set up an e-note. Investors come in. Some of them are big institutional investors now coming in, thanks to, but it means that we can offer that at $1,000 clips to professional investors, all of whom have already been KYC, AML cleared by the exchange. And I think that's another key thing is that, institutional grade KYC AML is coming in now, and we're seeing banks with subsidiaries who are focusing on custody of digital assets as well, so that money can come in confidently that there is that strong institutional framework.
Thanks very much for that, Tom. And it's very interesting in regards to your point about going after traders that are essentially less attractive to usual bank finances. I was on a panel actually recently where someone argued that there's more liquidity than ever in the CTF market. And while I'd argue that's true, I'd also argue that that's largely that money is with the top echelon of the traders. So how do we filter down some of this liquidity into the SME and mid-cap range? And I agree with you, Tom. I think it all comes down to speed and more transparency, faster service, otherwise, and cheaper, of course, as well. Otherwise, it's just not particularly worth it for some of these financiers. So that's a very interesting point. Just moving on to Jean-Marc, I'd like to get your perspective on this as someone with extensive experience in the banking world. Obviously, you've seen the impact of kind of moving into Basel III. As we're starting to look at the implementation of Basel IV, is this going to be more of a flight to quality, would you argue? And does this make it more of a necessity to find and develop other liquidity pools?
Yeah, so I've known the initial core, very, very, very buoyant CTF business in the year 2000, 90 and 2000. And I did a snapshot back. I went to Geneva a couple of times last 3 months, and I spoke to all of my ex-colleagues who are now mostly either running or CFOs in all of those trading houses. And clearly this gap exists. And I think it seems to have been driven by 3 factors. The first factor is, the main factor is that banks are effectively moving out of commodities in a way that they're not growing as fast as the commodity market. They're not moving out, but they're not accompanying the liquidity needs of the commodity market. And it's for 3 reasons, like everybody knows. The first one is capital regs, right? Basel 2, 1, 2, 3, 4, 5, 6, 7 are increasingly creating a hindrance to lending to commodities for regulated banks, number 1. Number 2 is ESG, right? ESG has created a bit of a shadow on commodity lending. There's a slight change of tack over the last few months, but it's very political and fickle. I think the trend is still there. And number 3, the reputational aspect, right, of lending to a company with $1 million of equity and trading massive cargoes. So if you add all of that, every company is short of the top maybe 5 or 10 who don't really need any help at this time, are kind of increasingly concerned about diversification of pool of liquidity, right? It's not that most of them manage to get the money, right, the funding. But the question is, what about the switch? What about if one day my bank calls me and say, we're out of commodities or we're out of you and you need to find an alternative. So this is the main risk of a commodity trade finance treasurer or CFO today, is the accessibility and sustainability of finance. And then you look at the fact that commodity trading is a very capital intensive and fast moving market, and you look at the slowness of the processes on traditional finance for commodity finance, right? A credit committee and the annual renewal. I mean, and you get into a situation where this gap is growing, right? And today, if you want to start a trading house, you need 10 million minimum ticket equity. Otherwise, no bank will talk to you. In my days, which are long gone, I saw some of the largest traders in the world trading entire chain of brand cargoes on $100,000 of capital. I'm not suggesting it's good, but it shows the direction of travel. So facing that, looking at the armies in presence, right? You've got I think like a 40 trillion market in commodity or oil trading, including paper. And then you've got a 27 trillion annual liquidity market in stablecoins. And then you think, well, something can happen here. We're talking about two major mature markets, right? Actually, the crypto stablecoin market is a mature market in terms of liquidity. Maybe not in terms of practices, but in terms of liquidity, it's bigger than most market we know. And then you start thinking, how do I bring that opportunity to commodity trading houses and bridge that gap? And my view is a bit more radical than my colleague panelist here. And I think it's about developing end-to-end non-bank financial rails. The bank is not necessarily present in that new pool of liquidity and value chain, right? And actually, it shouldn't be because banks are not native to that world. So they could be at the gateway, in and out, on ramp, off ramp. But inside, they're basically, by nature, not needed because it's a B2B market. It's a peer-to-peer market, right? There's no intermediation needed. That's the premises of blockchain and crypto. So bank could become a participant, but they would not have necessarily an edge compared to a liquidity provider who has a lot of capital, private equity, private credit. Then they'll probably be at a disadvantage compared to that player to provide credit into the stablecoin finance because of their own regs. So if you put all of that together, you can identify a new paradigm where there's not a bank. It's actually like commodity finance 2.0, which will coexist alongside, not replace, but coexist alongside commodity finance 1.0, which is quite antiquated, as we know, letter of credit and rollover loans, and will deliver three or four things. It would deliver seamless payments. For instance, you can pay a demurrage in a Saturday night, right? You can't do that with your bank. That sounds trivial, but it's a pain point. You can pay your whitelisted counterparts in a network any time of the day with no correspondent banking involved. So faster, cheaper, better. But then you've got deposits, right? A lot of the particularly larger one have positive balances. They could invest into a number of curated tokenized investments. There are many of them. There's today, I think, 8 billion of tokenized money markets and tokenized bonds. Some are BlackRock. I mean, it's a mature market. There's very little risk. You could go a bit more up the curve, investing into DeFi for those who are a bit more adventurous, but it's not needed. You could just lend your USDT, USDC for 7%. That's what I do in my fund every month to put my treasury to work. And you could also borrow. The borrow is the most exciting, obviously. I think we're talking a $5 trillion total addressable market, commodity trade finance, right? Today, I don't think you probably, the size of the crypto lending by latest count is probably around, it's still in the billions, right? It's probably $50 billion, but it's keen to grow. So this is where the connectivity can happen between those two worlds. But you have to think about it not as a transaction, a deal, a trade, but really moving some of the treasury of your float of your trading firm, maybe if you have a large one, maybe 100 million, 200 million, move it onto a stablecoin wallet. And then from that wallet, you can invest, you can transfer, and you can receive on another wallet loans. And everything is peer-to-peer with very little fees that are banking fees. And if you think about it that way, you end up in a much more transformational vision of commodity trade finance 2.0, which is effectively a non-bank financially driven pool of capital. So I'll stop here, but I really see that it's not just improving, going faster and better, but it's also accessing a different paradigm of finance.
I think it's really important to emphasize what Jean-Marc just said, because he said much more articulately what I've been trying to say. And I absolutely could not agree more that every $10 billion, $20 billion play in digital assets is about this end to end. It's about disintermediating, not jumping in and borrowing from this world using the old rails and trying to kind of fit it, or doing what we used to do back in the day with things like VACT and CumGo, which was digitizing the existing paper-based system and the bank-based system. And that's where the regulatory system, at least in the US and Singapore and UAE, has made it so much simpler now to actually create that yield-bearing environment without involving a bank. And the banks are fighting it because they don't want the stablecoin to give their financiers the same yield that they can, right? But that is the paradigm shift. And I hope that what people take away from this conversation we're having is there is a piecemeal way of thinking about this, but that's really been in play for a decade. What's happening today is this fundamental end-to-end, peer-to-peer, decentralized finance movement that really requires a very different way of thinking about this. And I'm so glad you brought that in, Jean-Marc. That's the play.
Yeah, and what I wanted to add also, sorry, I forgot to mention, but in terms of adoption is critical, right? The technology is there. Regulation, I'm sure Dina will confirm, but it's almost there in some countries. And what's missing is adoption. And adoption is about a network, right? What I remember keenly about my early days in commodity trade finance is the community. Everybody knows each other. There is a sense of finite club where you're able to de-risk your activity because you know each other. And I think the paradigm for the commodity, the industry to move into that new paradigm, it needs to move together. It can't be, company A, I'm the biggest, I'm going to do some trade in crypto, and company B following, and then all the rest say, what's happening, tell us. Which is the situation today, right? You have a few big players who are already quite engaged into stablecoins, make no mistake, mentioning no names, but they're using it. And the dense layer of lower top tier and mid tier companies, they're all like, wow, that sounds really exciting. How do I do it? So what's missing is semantic layer of access to this opportunity as opposed to do trades, right? Because there's nothing more dangerous than do a trade in crypto because the technology is fragile. You just send from wallet to wallet. If you have the wrong address, you lose, the money might not come back because the person might not accept to send it back. So it's key to build together this layer of regulation, security, and abstract away some of this complexity of that crypto, this, tokenization. It just has to be simple. I want to send to Bob, and I want to do it safely on that blockchain, and boom, is going. I want to borrow from John or Dina from this protocol, and I'm going to do it in that blockchain, but it's all into an integrated semantic layer. So we need that community work to accept, to move into that paradigm, and then that semantic layer to make it acceptable for treasurer to put that on the desk and do the trade.
And Jean-Marc, it's exactly why I think about the creation of the Brent crude benchmark, ICE, and Suco 90 BP GTNCs, because that was a community. And even the pioneers of digital trade around a Brent crude benchmark were Shell, BP, Chevron, Goldman, Morgan Stanley. Those five came together and said, we will now buy and sell against a pricing in benchmark that is outside of OPEC. It lives within Europe in a regulatory environment that we understand. And now over 90% of not just global crude, but every other pricing instrument we have is derivative of that. And that, I think, is the really big opportunity. And we sometimes lose track of what is desirable and the most valuable because we do fixate on the smaller piecemeal, which is appropriate for a lot of folks to do. But this market will achieve its potential, and its participants, the commodity trading houses, will get the most out of it if we do collaborate in creating some of that. And you don't need everyone involved, but you certainly need a few large liquidity providers and a few large flow providers. And this semantic layer is, it's what we've been working on for at least 6 years, where I come from. And all of the blockchain native and crypto native industry is ready to play because they want access to these real world assets. And they want us to engage with it as this integrated end-to-end of disintermediation where everyone can participate as long as they meet the KYC and regulatory requirements, versus the way we're thinking about it, which is, not the way we're thinking about it, but versus this access for the last mile or just the purely underserved. And I think that's important, but that's the first step.
In terms of community, just to add, I mean, it is very important, and I'm glad to see that there are initiatives there. The International Chamber of Commerce, ICC, has the DSI, Digital Standards Initiative, which has been running for several years. Again, bringing industry together in academies, in summits to build out. We've seen standards for container, for shipping, for electronic bills of lading. So all of the sort of infrastructure that then links into also payment processing, etc., and at least software firms and groups offering the controls. We use some groups, some systems which are institutional grade wallets controls, and it has all the controls just like a bank account. Someone sets something up, someone checks it, several people authorize. It's all digital, but again, to make sure that wallets are whitelisted, just like you might send a test payment to someone's new bank account. The same, taking a lot of what already works in the traditional financial world and applying those policies and procedures, not just regulations, but good best practice also into how we handle these stable coins and digital assets.
You guys are definitely making me feel a lot of love, because I was thinking it before you even said it out loud. I'm home with this panel. Every day I have someone ask me, what is it that you do again as a lawyer? And I say, well, I'm an energy commodities and derivatives lawyer. And they say to me, well, what stock would you invest in then? Because they never, like lots of folks don't know what we do just out in the streets. But I do feel a lot of love on the call because we're all commodities folks. And I do also feel a lot of love on this call because you mentioned regulation. Probably every single one of you mentioned regulation on multiple occasions. So usually on the boring part of panels, but not this one, because I'm home with my commodities folks, and regulation here is important, and it plays an important role. So together as a community, we're seeing a lot of changes in regulation that are going to propel everything that we're seeing and everything that Tom talked about and Mariam talked about and Alex and John Mark forward. Because right now we're beginning to see, as Mariam has said, the US lead the way in taking a regulation by enforcement, fragmented type system and creating and leading the way towards clarity, to promote innovation, and to promote more opportunity with regard to finance using all these asset classes. So your crypto, your stablecoin, but then also to do a little bit of what Alex was talking about, which was creating asset classes that are commodities. And if they're digitized, we have this opportunity to grow the finance in the commodity trade finance world. So just to level set a little bit, because you all mentioned it, and I'm going to close us out here just so that people understand why it's important, why you all mentioned regulation. So I'm going to start with the United States. Again, in the United States, it was a very fragmented and almost combative regulatory atmosphere for two reasons. One, you had two regulators, one that Mariam mentioned already, which is the CFTC, which is the Commodity Future Trading Commission, and you had the SEC, which is the Securities Exchange Commission, and also a little bit of the banking regulators sort of fighting over jurisdiction to regulate a digital currency, a digital asset, and no one really knowing where to step. They had a great idea or a great finance idea, or they had an asset that they wanted to finance, not really knowing where to step because they didn't know whether there was going to be an enforcement action. So in 2025, in the United States, you begin to see some things happening. One of those things is the Genius Act. So the Genius Act, as you were talking about, Tom and Mariam, like it regulates the issuance of payment stablecoins. So it requires, reserve backing, monthly audits, anti-money laundering compliance, but it also allows, a little bit more stability in the use of stablecoin, as you guys were all talking about, to be introduced as another way to provide financing. You also have in the United States the Clarity Act. Now, for me, this one's super cool because in the Clarity Act, it does essentially what it says it does, right? So if anyone asks you, if you're out on the street or you're at dinner and you want to sound smart and they're like, what's the Clarity Act? Aha, it provides clarity as to which regulator does what in the United States, right? And what is considered a digital commodity. So for the most part, you find in the Clarity Act, and this is me just making it really simple and short, that if you have a thing that is on blockchain, it would be considered a digital commodity regulated by the CFTC unless it is actually a security or some sort of financial asset that would be regulated by a bank. Very, very simple. Also in the United States, you have the Anti-CBDC Surveillance State Act. No, it's not a stake, it's a state act. And I hate acronyms, especially when I'm on webinars, because you never know when my mom is listening. So this is the Anti-Central Bank Digital Currency State Act. And what this act seeks to do is to block the Federal Reserve from creating a central bank digital currency for public use without congressional approval. Right now, this is only passed the House and it's in the Senate, but this is on our radar, and so I wanted to just mention it today. So the arbitrage inside the United States, and then again, I'll talk a little bit about, you all talk about the arbitrage outside of the United States and other countries, was really hindering development here. And we're beginning to see how regulation is playing a role in creating a framework where we'll have some innovation. And as Alex, I think it was Alex that mentioned, or maybe it was Mariam, there's a lot of emerging markets here that are using digital assets. And that's really cool. And you're going to begin to see a lot more of emerging markets. So I do an awful lot in sustainable assets and sustainable commodities. That also is an emerging market, which needs finance, right? And you're beginning to see that that emerging market is beginning to embrace a little bit more the digitizing of an intangible property right, which would be a commodity regulated by the CFTC, which would allow there to be finance of that collateral, project finance, and also commodity trade finance.
Yeah,
Also,
and Dina, sorry to interrupt,
yeah,
but
go
when
ahead.
I did my interview again in Geneva amongst the commodity traders, a
Yeah.
lot of them, the pain point is how to get dollars out, paid out of those countries in developing world, right? And obviously commodities in developing world is like, it's just the same thing. So stablecoin are a very elegant response to that issue of debankarization of or non-bankarization of commodities of the developing world, which is growing in size and in need. So it is actually unlocking a lot of value, this simple tool for commodity traders to access finance to be paid by these countries.
Yeah, and not only that, because Alex keeps talking about, like the physical commodity. I see the use of digital assets giving value where I've never seen value before. So like smaller farmers, okay? You can, in some of these emerging markets, you can digitize things that we've never digitized before, perhaps provide more finance, perhaps provide more opportunity. There's a great example of that again in like the sustainable world where you can have a farmer use a sustainable type of product or sustainable type of um, mechanism to farm. They can then collateralize the sustainability, right? And then that creates financing. It's just a different way and a different opportunity for all different types of farmers in every part of the world. And what we're seeing in the United States is that the IRS is treating these cryptocurrencies and digital assets as property, right? So that again is a very important aspect to understand because if it's a property, right, we can lend on it, we can finance on it, we can put it in a borrowing based type of thing. So we're beginning to see those things happen also in the United States. You were going to
So,
say, go ahead, sorry.
quick question for you, Dina.
Yeah.
I really believe one of the killer app of stablecoins for commodity trading will be to be able to have elective collateral, stablecoin collateral for commodity hedging contracts, right? So, and we know that a lot of finance pain point in commodity trading is about margin calls. It's the big issue, right? And here again, the question to you is, what is the status of? I've heard that the U.S. might consider that stablecoins are elective assets under collateral management.
Great question. I do not know the answer to that one. I do believe you're right, but I would have to look it up to know for sure.
That would
I
be a
do think,
great enabler. And if
yeah,
that
I think you're
happens,
right though,
the
because the
use
whole
case for
point,
stablecoin explodes.
yeah, because the whole point of the regulation is to make sure that you know it creates a liquid asset in every area of circulation. So I'd imagine that you're right. I would imagine that there would be no reason why, because it mandates audits and anti-money laundering and consumer protection standards. So you would think that you'd be able to elect a stablecoin,
I
right?
mean,
And the backing
collateral,
for the
the
stablecoin,
crypto market
you
is
know,
largely a collateralized loan
yeah.
market. When I mentioned this $50 billion of crypto lending, a lot of it is collateralized. It's a little bit circular because a lot of it is collateralized by crypto assets. But nonetheless, it's a very efficient market in that sense because it knows how to integrate collateral with the principal asset in the same wallet integration system, as opposed to go out into fiat, into dollars and pledge, send
Right, and then
funds
having
to
to pull it
pledge
back.
something. So
Yeah.
the efficiency gain will be tremendous for commodity traders if they start moving their business onto stablecoins and they can use the stablecoin as collateral to their CME contract, for instance.
Sorry, you were going to say,
No, I mean the operational model of crypto trading, which what's what we do all day long, right? We trade a couple of billion of crypto a year. Everything is backed by a stablecoin. So our investor send us dollars in the bank. We convert that into stablecoin on day two, and from then on until such time they redeem, everything stays into that world, including in some cases them paying us the management and the performance fee in stablecoin. So we're not talking here about a dream here. It is happening at scale within the boundaries of the crypto markets for a lot of size. I mean, the very large US firms proprietary trading firms, which are the equivalent of the large commodity traders on finance, are doing it, and they're using collateral, stablecoin as collateral as we do. So we're only asking and thinking, how can we bring that opportunity to commodity trade finance and commodity traders? And really, it's about this bridge and this semantic layer and its adoption, because the technology and liquidity are ready to go and support them. If you talk to my colleagues on the side of the crypto side, they're all salivating at the idea that they're going to, at some point, do business with crypto. And they're asking me, I don't understand these guys or girls, how do I do it? And then, so it's people like us who could create this bridge, intellectual and technological and semantic bridge, to bring crypto to commodities. It needs to be an industry play. It can't be just a couple of companies shooting on the side, doing their own business on the side, because by essence it's B2B, it's peer-to-peer. So you need to be two to tango. You need a huge room of people dancing together.
I see it exactly the same lens as you do. It's really easy to sort of imagine that the secret sauce is tapping from our commodities box into and picking bits and pieces of this DeFi world and bringing it into our world. But the secret sauce is actually understanding that it's a fundamentally different financial system with its mature regulatory in most parts of the world, with evolving environmental an environment of support. But we actually have to mobilize commodities to show up. We actually have to mobilize the flows to show up, not the other way around. And that's sort of why, for me, the work we did in setting up the early consortia around leveraging blockchain, in my mind, that remains the model. Back then, we did it for post-trade processing and efficiencies, and it worked beautifully. Today, it's about really creating this new financial end-to-end that allows us to tap into a very different model of liquidity provision, pricing, price discovery, benchmarking, indexation, all of those things, right? And that's the trillion.
Yeah, the bad news, because there is a bad news, is it's a 24/7 market. So you can't go to the club on a Friday night anymore. You have to stay. I mean, a lot of it is automated and algorithmic. So in that sense, it's possible to transition into 24/7, provided your trading approach is relatively automated. It will push, I believe, to the further automation of commodity trading, and the classic, one man buys the entire cargo chain and sits on it for 2 months. These days are over. We know that, right? Thank God, because that's not really the spirit. The spirit here is about decentralization, and that reduces the main issue of commodity trading, which is single point of failure. And I'm afraid at some point in the last decade, the banking system has become a single point of failure, potentially, for commodity trading, because it can stop overnight, either for political reasons. So that creates a big challenge forward, that this type of alternative liquidity pool can somewhat help remedy. Somewhat, because it's not going to replace it.
I just want to keep moving in the regulatory discussion, because we keep going back to like the trading and the use of stablecoin and cryptocurrency to facilitate trading. But there is a pretty exciting thing happening just with the creation of digital commodities, period. Right? The creation of digital commodities, it's really going to open up these markets in many ways. Now, I will say that the Clarity Act does not allow payments by stablecoin. However, it does set up a framework to digitize commodities. So we're able to see the use of blockchain networks to digitize things that we've never digitized before. And that will open up, at least for now, a different type of collateral asset class that can be used and borrowed against and traded against. And it does open up a lot of innovation, and it does allow for the commodity markets to, move, as we said, away from being seen as antiquated, which is, I do agree that was how we were seen as a community, but I think we are pushing this along, and it does start with, the acting chair of the CPC. She's wonderful. She is absolutely ahead of her time in this regard. We
Should get her on the podcast, Charles.
Well, yeah, we have to get her on the podcast. We do have, though, as you guys were mentioning, some regulatory arbitrage, right? Like, I'm not a lawyer in any other country. I have to say that out loud. But, for example, in Canada, they require cryptocurrency trading platforms to register with their regulators, right? And if you're an investment firm, you're classified as a money service business, and digital assets are taxed like commodities. Okay, so that's different. In the United Kingdom, in 2023, the FCA, which is the Financial Conduct Authority, introduced even stricter rules on crypto advertising, right? So that is almost like an arbitrage. So you can't advertise your business. That's not going to work. So you're going to pick another jurisdiction. And they also expanded their oversight on stablecoins, creating an even broader framework for their regulatory oversight of crypto. We talk about Singapore. Singapore licenses cryptocurrency exchanges and custodial wallets, but it's a lot more detailed guidance on risk management and advertising. So a lot of folks, when they're beginning to think about where they're going to put their new exchange or where they're going to begin a new business, like you all do, they look at Singapore because the rules there are a little bit more detailed and a little bit less, you're not as worried about regulatory risk and enforcement risk. So again, in the EU, there is the first adoption of crypto regulation in 2023, and they set common rules for the issuers of stablecoin, crypto asset service providers, and trading platforms, emphasizing investor protection and cross-border regulatory consistency. But you're just beginning to see that kick off. But every time you have this type of market that is global, which is what we do anyway, okay, we've never done anything as commodities professionals that wasn't global. But in this case, when you see an emerging market, a new type of asset class, perhaps as you're talking about a new type of mechanism for payment and B2B with this type of regulatory arbitrage, we are going to still have a little bit of fragmentation until we get that aspect of the regulation a little bit more aligned. And for me, I'm going to close there because I do think that is, although I'm very excited about this market, that is something we will have to overcome or figure out how to deal with as a commodities community, as you all say.
Thank you very much. This has been incredibly interesting. And I also want to thank you, Dina, for bringing up the regulatory side, as regulation with everything is key to this. And if you want to know about regulation, you ask a lawyer. So that's always a good thing to do. So I had loads of questions about scalability, speed, how to make it more mainstream, how to, all of this kind of stuff. But we've kind of covered the majority of it now. So, Mariam, you brought up a point very early on, 314 billion in stablecoin. The technology is there, the finance is there. We talked a little bit about the adoption, but potentially missing. But how do we make this mainstream? And I want to take this on to, I want to hear from Alex on this as a industry figurehead of the CTF market. How can we make this mainstream when we've got all the other pieces effectively in place?
I believe we stopped now the discussion at the point of regulation, and I can start my discussion right there because I really appreciate the insights, about the regulatory environment in US, in Singapore, and in the UAE. But as you know, in order to capture value as a commodity trader, you have to have a global setup. So what's really relevant, to have a level playing field in terms of regulatory arbitrage. So we are a mid-cap player and still present in 27 countries. So imagine, the majors who have like over 150 offices worldwide, and you certainly have to adhere to the regulatory environment of every district you're in. So technically, my call, for regulators worldwide is really, to get a uniform approach, so that at some point, real world can marry up, to the crypto world, that we have uniform regulatory regulatory environment, or as close as it gets. Of course, there will always be gaps. Nobody will ever adhere to 100% thereof. So that would be, a globally acting company being, compliant to every jurisdiction and be able, seek solution also within these liquidity buckets.
Thanks very much, Alex, on that. The last question I had was, how is this market going to look like in the next 5 to 10 years? And I think that would be quite a good thing to kind of close on. So perhaps if everybody maybe has a few words that they could maybe say in terms of what does this look like for the next 5 to 10 years?
I think in 5 years, it's not even 10, close to 20 or 30% of commodity financing, trading, pricing, and settlement, the end-to-end, will be blockchain native. I think we'll see multiple competing pricing benchmarks for oil, for rare earth metals, for other assets, LNG, beyond the Brent-based WTI version of the world we're used to. I think we'll see NOCs mostly participate in a world where we claw back a lot of that control. We'll see pre-production come into play as an asset class that needs to be fundamentally financed. And because it is not today financialized, that's where I would focus. That is where I am focused. I see us at the third tectonic shift in digitalization of capital markets. NASDAQ in 71, replacing phones with screens. ICE in '05, replacing open outcry with electronic settlements. We see this from not just the trading or the capital formation, but we're also seeing it from the coming together of those who own the flows and control the market today. And so we will see a leading collection of the large super majors, NOCs, trading houses, join forces with the largest crypto infrastructure participants and the largest liquidity providers in that world, with some traditional banks who are first movers. We're already seeing Standard Chartered, Citi, JP Morgan really want to lead in that space. We'll see new coalitions that rival what was done with Goldman, Morgan Stanley, Shell, BP, Chevron at the creation of the first benchmarks. And I think it's a much, much bigger play than efficiency or using stablecoins to finance the last mile. But those use cases are critical, and they are wonderful proofs of concept for what is possible so that the bigger participants can come in and leverage them.
Thank you, Miriam. That was great. I agree with you. I'm just going to add on to what you say here. So it will come fast, as you mentioned. The future is now. Some of the things I think we're going to see in the next 5 years, and I should probably say this word because I may open up a whole other conversation, is I do think we're going to see the use of AI being implemented in the next 5 years for the management of digital assets. I do think that we are going to begin to see and continue to see a trend in the tokenization of just about anything, right? I think folks are going to like the efficiency and the effectiveness of tokenizing anything, which means we're also going to begin to see the improvement of custodial type services for these types of assets. So we're sure that, like you would have gold in a warehouse, you have your token somewhere, and a custodial service could be used as a collateral, and you're quite certain it's there, and it's protected. Your lenders would be protected from your bankruptcy and things with that token being, which we didn't even get to talk about, Mariam. You mentioned bankruptcy across the world, but that would be one of those things I think we're going to see in the future. So that would be where I think we are in 5 years.
In 5 years, I think I can see a world where a commodity physical firm treasurer will have a dashboard on their desk where they can effect transfers on stablecoins, choose which stablecoin they use, on which blockchain. They can choose where they deposit their cash that is idle on the wallet. And they can also borrow from stablecoin private credit funds that are going to emerge in the next couple of years. The last nut to crack, which is the toughest one, is one of the most promising is to create native commodity hedging contracts on chain, meaning it could be a perpetual swaps. The most liquid asset traded in derivatives in crypto are called perpetual swaps, and they have not yet developed perpetual swaps on crude oil, on copper, on gasoline, or whatever. This is the next thing to happen. And once you have moved the treasury of the commodity trading firm on an end-to-end treasury with deposits, payments, and borrow, and then you have collateral, and then you have the hedged contract, you have completely integrated the entire chain, and you're moving into a complete autonomous world that is that where the assets moved on chain. That is my vision in 5 years.
Well, I support everything that's been said so far, and I think really coming from an investor standpoint, enabling trade, I think blockchain converging, with stablecoin is very exciting. I think it is going to revolutionize stuff. Asset tokenization, at least will allow fractional investment into transactions. So I think that will certainly open up more things. And I think perhaps just over the next couple of years, the most exciting thing I think within the next 12 to 24 months is finally the ability to do automatic reconciliation between sort of payments coming in and actually the physical release and title transfer of goods automated using smart contracts. So this, again, it's about security, it's about movement of capital and reduce costs. The fact that this will become the legal transfer and the legal management of trades will become much lighter touch, more automated, perhaps powered with AI, machine learning assistance, etc., which means that things, the cost, the friction of doing transactions will reduce a lot. It'll mean more people will be able to, or companies will be able to show their transactions for financing, but also for the bigger traders as well. Not just small traders, but bigger traders will also be able to potentially syndicate financing more effectively, because it's in the real, in the current sort of traditional finance world, syndicated financing can be very, very slow, cumbersome, and not always work out. And so I think there's a lot of great opportunities there to bring efficiencies and cost savings, as well as opening up more liquidity and bringing more investors in.
Let's see, with the rise, of crypto financing and lending, into the commodity space, also paradigm shift in terms of market participants. Back in the years, we have seen that, with certain hedge funds, which have emerged, from classical lenders actually to traders themselves. Now we have seen, recently the likes of Tether acquiring an agricultural business and stepping into the trading business themselves. So I believe, when we speak about majors, I think, the landscape of majors will be reimagined, over the next 5 years. And clearly, to support the visions, of my co-panelist is definitely, approximation of the crypto lending space and the classical commercial bank and classical lending space, which will kind of challenge each other in terms of regulatory environment and landscape. There has to be a common denominator, how these ecosystems can, interface in each other and work together rather against each other, because that would provide the liquidity required, to close the trade finance gap. And of course, from a tech perspective, yes, there's going to be, like today, we have a multi-banking cockpit, where you put all banks together. You will have, software dashboards. Will you have a visibility as a treasurer or a CFO, where you really have a financial cockpit that will be able to trace back and monitor the entire financial universe backed by cryptos and traditional lending.
Thank you very much. I think it just remains for me to say thank you to the entire panel. So thank you to Tom, to Alex, to Jean-Marc, to Mariam, and to Dina. Thank you for joining me and providing your expertise. Thank you for everyone that listened. For me, this has been fantastic. It's tantamount to going down the pub and having a very open conversation. And to be honest, I was happy to just listen for the majority of this. It's been incredibly interesting. We at Trade Finance Global, we're committed to not just endlessly talking about the trade finance gap, but actually talk about actual solutions and speak to those that are actually providing solutions, as are everybody here on this panel. So thank you to everyone that has indulged us on this and that is committed to listening to TFG's content. And I look forward to welcoming everybody for the next installment of Spotlight On. Thank you.